we're probably all a little tired. We made too much money today, right? And we're all wore out. All right, joking aside. But we do appreciate you guys being here at the end of your day. So hopefully we'll bring value to your trading, and it'll be worth your while. I like to think that it always is. So, as Josh did mention before, my name is Will Busby, CEO and founder of Pure Financial Academy. And today I'm going to just give you a really quick run through. I do my best, guys, when it comes to these webinars. I know you've probably been through a lot. You've probably, seen most of the stuff out there, and sometimes it can be boring, right? So I'm going to try my best to get you guys through the boring part really quickly into the fun part, okay? I'll always like to do that so we don't waste too much time. So what I'm going to do, we have a few slides here. Now, oh goodness, here we go on a PowerPoint, right? Doesn't sound fun, but we're just going to run you through this, like I said, really quickly. It's imperative that you understand the slides first before we look at the live charts, else you're not going to know what we're talking about when we define price patterns and so on and so forth. Okay, so bear with us through these slides, and we'll get you out to the live charts so you can actually have some fun. Okay? All right, so as a disclaimer, you all know that this is for educational purposes only. Trading does have risks and rewards that we need to be aware of. Okay, I'll let you read through the disclaimer. Of course, by participating in this education, you are agreeing to all of the terms above, and you obviously accept accept responsibility for your own trading and investing results. Okay, so we're just going to talk about supply and demand. And again, as I stated, we're going to move really quickly. If you guys have any questions, I promise you, I will try to get to your questions. So don't worry, all right? But it's a 10:30, David. Wow, that's pretty late, my friend. But bear with us, if you will. Just hold your questions as much as possible towards the end of the session, and I promise you, we'll do a Q&A, and you'll gather all the information. Okay. All right. So obviously, we need to understand price action to know about supply and demand, right? Everyone always asks, well, what do you trade? Price act? Do you trade pure price action? Well, we trade supply demand. Well, what's the difference? There's a huge difference. Price action, I love this term. Price action, in our opinion, and not that our opinion is right. No one's right or wrong. The question is, do you make money or don't you? If you are making money, if the answer to that question is yes, then you're right. And that's all that matters, right? If you're not making money, then maybe we have something to offer you that you're not already doing. So you might want to pay attention to that. But in our opinion, price action is nothing more than a painted picture. Okay? It's literally nothing but a picture on the chart displaying the underlying, which is supply and demand. Okay? Supply and demand is nothing more than an economic model of price determination in a market. It concludes that in a competitive market, price will function to equalize the quantity demanded by consumers as well as the quantity supplied by producers. This is going to result in an economic equilibrium of price and quantity. It's basic, right? It's just the supply and the demand. If there's an imbalance, we're going to be off. We're trying to equalize that. We got to find common or middle ground. All right. So the supply, is obviously when there's an abundance of an instrument, okay, or whether it be equities or futures or what contracts, whatever it is that you're trading. When the supply exceeds the demand, there's going to be a turn in price action. Okay, price is actually going to be driven down, obviously, to the quantity of those goods being produced and the lack of demands for those particular goods. What does it look like on a price chart? Well, as you can see here, we have a red zone there, all right? And price has reached an area where the supply does, in fact, exceed the demand, and it drives prices lower. Now, why would I say that price action is nothing more than a painted picture on a chart? Because in order to understand the picture in itself, you have to know what it's actually doing. So when we reach areas and there's an extreme imbalance, this is the picture that you're going to see. Okay? Areas of supply simply paint you a drop in the chart. That's it. It'll give you, depending on the color of your bars, of course, you could have red. I mean, you can color code your bars whatever you want. In this situation, we have red bars as negative bars. So notice what happens each time we leave that red zone. All right? Do you notice how we have extreme red bars, that's showing you that there's extreme weakness coming out of that particular area. The absolute high of each of those pivot highs, okay, so the absolute highs here is the origin, what we refer to as the origin of the move, which defines the highest price point where the supply allowed price to go to. So the demand is just the opposite. I'm going to keep moving here because I don't want to waste too much time here. We all know supply now, and we know that demand is the exact opposite. So when demand exceeds supply, there's also a turn in price action. But price is not driven down, it's actually driven up, and that's due to the quantity of goods being demanded and the lack of supply for those particular goods. In other words, there's a lot of want for something and not enough of that something. All right? So in this particular picture here, we have a green zone drawn, and price here has reached an area where demand exceeds the supply. So the exact opposite of the previous slide that we saw of price action. All right? Same scenario, guys. Notice what happens each price point, okay? Notice what happens out of each price point here. Okay, these two lows that hit the green zone. Notice the green candles coming out of them. That is a painted picture to do nothing more than tell you that demand has taken place. All right, buyers, that's it. That buyers have stepped in. Now this is where it gets important. This is what you need to understand before we get out to the live charts. We need to know about the patterns because we are going to refer to these when defining our market structure. And we're going to talk about market structure like let's just say very intensely, okay, because that is the most important thing outside of supply demand that you will ever know in the market or that you need to know. Okay, so peaks and valleys, it's literally just another name for market turning points. Peaks refer to the top of the area where price turns to the downside, and vice versa. The valleys refer to the bottom of the areas where price turns to the upside. Okay. Peaks you can refer to as, some of you may know peaks as rally-based drops, okay, or swing point highs. Both those are all the same, but we prefer the terminology peaks and valleys. Okay, peaks become areas of supply, and they are created by a rally-based drop formation. Now you must have all three formations in order to create our peak pattern. Valleys are the exact opposite. They become areas of demand and are created by a drop-based rally formation. And bear with us, traders. I know that we're going really fast right now, but once you see it on the price chart, it's going to make a lot of sense, and it will make a lot of sense really fast. All right. So these formations are created by an imbalance in supply and demand. That is actually spelled incorrectly. That should be an M instead of an N, so pardon us. All right. But they are created by imbalances in price and nothing more. Okay. Is the equilibrium in balance or is it out of balance? That's what we need to know. So these are peaks, okay? Just very simple swing point highs. You can think of it as the top of a mountain, all right? We know to the peak to be a top of a mountain. That's exactly what it looks like on the price chart, okay? Valleys are the exact opposite. They are the bottom of those particular areas and or the valleys. Think of them between the mountains. You have the valley in the lows and you have the peaks as the highs, okay? Keep that very simple. So here we have a peak. We're breaking this down because we want you to understand the price pattern in itself and what creates that formation. All right? So here we show you we need a rally in price. We need it to stop and base in one area. It doesn't matter how many candles. It can be 1, okay, up to 5. All right? But we need it to stop at one point, and we prefer that it only has one candle because that clearly shows us an extreme imbalance in price. Think about it. The more we move into an area and we sit there, what's that telling you? That there's an indecision, that there's no clear imbalance. That's not good for us because we want to see the areas in which there is an extreme imbalance. Happens much faster. So here we have a rally-based drop, okay? We're going to refer to that as a peak. We also have the exact opposite as a drop in price, a base. Basically, you can think of the base as the absolute low or the absolute high, okay? Just the price point of the peak or the valley. In this particular case, we're looking at the base of a valley. Okay, and then we have a rally away from it, thus creating our valley pattern. All right. Continuation patterns. The last two patterns that we're going to talk about before we move out. Okay. Continuation patterns are areas in which price has driven to. Okay, so it's driven to one particular area, then it paused. All right. The reason that it's pausing is because it needs to regain momentum. So we look at two price patterns to determine a continuation move. We look at rally-based rallies and drop-based drops. Okay? So our rally-based rally refers to a continuation pattern that's obviously controlled by the bulls. Because we're rallying in price, we pause and we continue to rally. All right? So the buyers are controlling this. This can act as an area of demand for an upcoming trade setup. All right? Because it's painted a picture that displays where the actual imbalance took place. Drop-based drop refers to the continuation pattern controlled by the bears. Okay, this also can act as an area of supply for upcoming trade setups. Very, very powerful patterns, and we're going to show these here in just moments away. These formations are created by the imbalance between the supply and the demand also. All right, there you have a rally-based rally pattern. We have a rally in price. We pause, moving sideways, and we move again to the upside. So a continuation pattern. We're moving in one direction, and we continue in that direction after a pause. We then have a drop-based drop pattern. We have a drop in price. We pause for a moment, moving sideways, and then we have another drop in price. All right, supply demand on multiple time frames. I'm not going to cover that slide as of right now. We'll just move forward so I can get you through this. Trend versus counter trend trading. You need to be really aware of this, guys. Applying the larger time frame supply demand, it's going to add probability to your counter trade trend. Excuse me, I said that backwards. To your counter trend trade. Every single trend out there is going to come to an end, and it also has a beginning. So be aware of that. Every turning point is created, and I do mean 100%. Of the turning points are literally created by an influx of either supply or demand, one of the two. If it's a move to the upside, it was demand. If it was a move to the downside, it was supply. These areas are going to be found on the larger time frame. Okay, so it gives us the large outlook in the markets. Trending is caused by areas of supply, okay, and areas of demand being apart from one another. So what they tend to do is act as a magnet. Right? In other words, if you have an area of supply way above and you have an area of demand way below, but there's nothing to stop you from getting back and forth between, those two areas are going to act as a magnet towards one another. They're going to literally pull price action they're just going to go back and forth, thus creating sideways markets. Okay? As we locate the true supply and the demand in a market, we can now use the smaller time frame demand and supply and or supply, okay, to trend to these areas. So for example, on the larger time frame, if we have an area of supply above, which is a long ways off, and there's nothing to stop us, we then can drop to the smaller time frame and play our areas of demand all the way along. Okay? All right. So we're not going to cover into this slide too much either. You can check out our PFA package and our package MTF on our website. Okay, so go ahead and visit it at purefinancialacademy.com. Get you in there for a free trial and so on and so forth. Feel free to give us a call or email at any time. Doesn't matter if you're a member, guys. One thing that we try to pride ourselves on is the personal attention that we try to give our clients. So if you have emails or questions or anything about anything, referring to our company, of course, or trading, then we're happy to get that over to you. Okay? So I'm going to stop the application sharing now unless anyone needs this up, and we are going to get to the live charts and start to have some fun. Bear with me again, guys. I know that I'm talking about 90 miles an hour, but it's all the boredom things, right? If I'm in your shoes, I really don't want to stare at a screen of pictures all day long. I want to see some live charts, so let's do that now. I'm going to stop the application sharing. Okay, and we will switch up our screen here, and I'm going to get you out to the chart, and there we are. Okay. All right. So you should all have our charts up now. Um, let's have some fun, guys. Okay. If you have questions along the way, please feel free to ask. But just remember, if I don't jump on it right then, I'm going to go back to it. Okay. So I'll try to address those questions towards the end of the session, if that's okay with you guys. All right. Got to get these guys at Trader Kingdom. I'm sure they have a lot to do as well. Okay, so we don't want to run over time too much. All right. So what we're looking at first and foremost, we're looking at the major indices or a couple of them. We have the S&P up. We also have the Nasdaq, but then we have Forex up as well. Now, excuse me. You say, why do you have Forex and futures up? Well, because what we trade, i.e., supply and demand, it doesn't matter what you're looking at. Okay, it doesn't matter if you're looking at futures, Forex, equities, options, okay, anything, because supply and demand is relative to all aspects of life, not just your trading, right? Not just your trading. How about your grocery shopping? And I use that analogy a lot. How about your purchasing a new vehicle? How about purchasing that home that you've been wanting for so long? All right? All of these things, clothes shopping. You think that it just applies to trading, but it absolutely does not. It refers to everything in your life. And trust me when I say everything. How many of you, and I don't even want you to raise your hands necessarily, but I want you to think to yourself right now, how many times have you gone to the convenience store? You need to get gas, okay? How many of you have gone to the convenience store and you're just, how is gasoline $4 a gallon? Okay? How in the world is it $4 a gallon? That's crazy, right? But what you need to understand is that is nothing more, nothing less than supply and demand. Don't you think it's weird when you go back to that store a week later and the gasoline is only $3.45? Isn't that strange? But what do you think happened? There was an imbalance that took place, all right? The supply exceeded the demand. In other words, they drilled more, or whatever the case may be. They have more oil, more barrels, or they've produced more gasoline than people are buying at that given time. So there you go. You have a drop in price. So now let's apply this to the chart. All right. As we're looking at the chart, we're going to talk about a few different things, and the webinar is Market Structure Unleashed. Okay. So let's go ahead and focus on the market structure alone. Now, in order to understand it, you need to know those 4 patterns that we talked about before. And we're going to go all the way back. We'll just pick a random spot on the chart. Okay. Literally, we'll just pick a random spot on the chart. How's this? So what we need to be aware of are the trends. I'm sorry, guys. Let me get onto a larger time frame here. It'll be much better for us. Okay, 60-minute chart. I was looking at a 5, and we'll jump out to the 60-minute chart. Okay, so again, I'm going to go back, pick a random spot. Actually, we'll just go back to the beginning. So we need to determine the trend. In order to do that, we're literally just going to pay attention to swing highs and lows. That's literally about all that we need to know in order to give us a belief or a permission of which direction the market is actually going. So I'm going to open this up a little bit. Okay. All right. So the market structure here is defining that we're in an uptrend. I would clearly say that, right? But you're looking at it in retrospect. We're going to teach you how to do it before it actually happens. Okay. So we're going to start at this pivot low right here, and we're in an uptrend. Clearly, we know this now, but how would you know it at the time? Bear with me, and you'll know that. I'm about to show you. Give me 5 minutes. Okay. What we are looking at, and what I define market structure as, like I stated, pivot swing lows and pivot swing highs. Okay? Just like that. So here's a pivot low. We're going to find the major pivot highs and lows in this trend. There's a pivot high all the way down to the pivot low, another pivot high, a pivot low, pivot high, pivot low, and so on and so forth. Okay, so I think you're starting to get the idea now. Just literally pulling out the pivots and the swing points in the market. So you're going to ask me, why are you doing this? But you will clearly understand. Okay? All right. Now, I've just drawn the major swings in the market. That's basically what I've done here. Okay? All right. So, excuse me, and I should have drawn it like so. Bear with me 2 seconds here, traders. Just want to draw that for you. Pivot high to pivot low. All right, there we go. So if we're talking about the market structure, we want to know, are the highs or the lows being violated? Which one? Is it the highs or is it the lows? Well, right here, well, and we've been covering this vastly in our courses lately, guys, and the traders are really enjoying this. So we want to see, are the highs and the lows being violated? Right here, you can see that we have a pivot swing high. Okay. Now, trust me when I say, I know that some of you right now are sitting there thinking, well, this is basic stuff, right? Are you making money? Just ask yourself that question, because if you're not making money and you think this is basic stuff, then you might want to pay close attention. All right? But just bear in mind that the markets are as simple or as complex as you want to make them. And in our opinion, yeah, the markets are extremely, extremely simple. And it's as easy or as hard as you want to make it. So what we're going to talk about here is this pivot high. What we saw is it clearly got violated right here. Okay? So what that then does is gives us a permission and states what the direction in the market is. So we know now that the direction of the market is to the upside. So that then gives us a permission to trade long. So what's the first thing that we need to see? Areas of demand along the way up. Okay? We need to see those valleys or the rally-based rally patterns. Okay? So look at what happens the first time that we revisit that area of demand. This is our buying opportunities. You need zero, okay? You need no indicators. You need nothing more than just literal price action to do this. It's the way that we trade every day, guys, okay? It's the most successful thing we've ever traded. Just nothing but price action. I'm sure you've heard that. All right, so then we're going to continue in the given direction. All along the way, we are looking for the market structure to tell us where and when to get into the market. Okay? So along the way here, where's the major imbalance that took place right in through here? We come up, we form a pivot high, and we violate above that pivot high. We then look to pull out the meat of this particular level. Okay? So we would mark this level just like so. Now, being accountable. We don't always capture every single trade in the market, obviously, right? So here, we would have had to sit this trade out. It is what it is. And the sooner that you learn patience, the more successful you can potentially become. So we don't have a trade set up. We simply continue in the given direction. We then wait very patiently, traders, for the next pivot high to be violated. All right? Once this happens, what do? Look for a trading opportunity out of our area of demand. Unfortunately, we don't get it again. Okay? So it is what it is. What do we then do? We wait for our pivot high to be violated, and we look for our area of demand. Now, all of a sudden, you have this buying opportunity. Price clearly moves in your favor. Okay? I think that's pretty easy to say. And you know this by not looking retrospect. You know this before it ever happens. We knew this here. Okay? That's where we knew it. So then we begin to wait for our next trade setup. And then it finally revisits the areas in which we're willing to take a trade. So you buy limit longs, just like that. Okay? Just like that. And then we continue in the direction. Now, I told you I was going to teach you how to know when a trend begins and when a trend ends. Let's remove these drawing objects, please. There we go. Okay. The beginning and the ends of the trend are, in my opinion, one of the most important things, or the most important factors in your trading. Why? Because you can literally capture them from the absolute top or the bottom. Okay? Very, very nice method here. Remember, guys, just bear with me on the questions, and I will go back and get these. There is no confusion, and you'll understand why when I'm done, because it's actually all going to be done for you, which is phenomenal in itself. All right? So we're going to continue looking in this given direction. How we know we're going to measure the trend, and we refer to that as the mean. Okay, so we want to see reversions to the mean. What does that mean? It means that we want to have pullbacks or corrective phases back to the trend line in itself. Okay, so we're going to measure, all right, the trend in itself, point 1, point 2, all the way up, okay, just like that. When the trend is broken with conviction, what does that mean, Will? It means with a full candle back below the trend line. Okay, so if we're in an uptrend, we're looking for full candles below. If we are in a downtrend, we're looking for full candles back above. We're looking to break the trend with conviction. That is how you know that the trend is now giving you a permission to change your thought process and revert to the opposing direction. For example, we have a trend to the upside. We violate it with conviction right here. So what's the first thing that we do? We then look for an area of supply. We need a reason to get short the market because it's already given you the permission. Okay? It's already given you a permission to get short. Now, all you need to do is wait for it. Okay? Just wait for it. There it is. Okay? Just like that. So if we're patient and we allow the markets to come back to us like we do in every other aspect of our life, then you're going to do a lot better. I can almost guarantee you that if there's a used car out there, okay, let's say maybe you don't have a lot of money. Let's say you have $10,000 put towards a new car. A used car. Okay. Now that used car is $12,000. So you can't really, you don't have that much money. Okay. Are you going to go to that particular car, the owner or whatever? You know money. Okay? Are you going to go to that particular car, the owner or whatever? You know that you have $10,000. You hope that he'll take that. Are you going to go to him and say, "Look, I understand that you want $12,000. I'm very sorry. All I have is $10,000, but I want to offer that to you because I would love to have the vehicle." Or are you going to wait for him to drop it to 10,000 and then go and try to buy it? I'm pretty sure that most of you are going to go ahead and offer him. Why would you do that? Because you know if he drops the price on his own, then other people are probably going to get that car before you because maybe they have $11,000. Who knows, right? So why do you look at the markets any differently? Once you see the permission, all right, i.e. the trend being broken, we then say to ourselves, I have $10,000 that I am willing to spend in the market on that vehicle. This is $12,000. Am I going to wait for it to get all the way back up there, or am I going to offer $10,000? I'm going to go ahead and offer it, meaning I'm going to place my limit order where I know that the buying and selling should take place in the market. Okay? I know I see questions about, confusion. Look, there it is. Okay, it's all done for you. I'm not showing you this yet because we haven't got there. Okay, so there is no confusion. All right, so we're going to continue forward in time. We now ask ourselves, what is the trend? What's the current trend? What's down, right? Because we violated the trend with conviction. So now what are we doing? We're looking for shorting opportunities all along the way until we're proven wrong. You ever heard the saying that it works until it doesn't? Boy, how true is that? It works until it doesn't, guys. Okay? Absolutely it does. So we continue all the way down, and we find areas of supply along the way, right? For example, some of the things that people may not realize are hidden areas of supply and demand. Remember what I said. We need pivot lows to be violated. Where did that happen? Right here. Where's the area of supply? Right here. So after that low became violated, then we place our order here, anywhere in the zone. Okay, so here, just like that. We then must wait for our next trade setup. So what are we going to do? We're going to analyze the trend in itself. So let's draw a trend line. We're going to go 0.1, 0.2, all the way down. Okay, just like this, all the way down. When does that trend actually get broken? Now I want you to ask yourselves that question right here. I think that's pretty clear, right? Remember, we need conviction. Do you see full candles above it anywhere until we get right here? Absolutely not. So once we revisit that area, what's the first thing that we're looking for? Areas of demand, right? Areas of demand. Just like that. Okay? I could be using rays here, guys. Give you some labels, I guess. Okay? Just like that. Now, in this particular case, it doesn't turn back to the upside because we're not 100% right, but doesn't really matter, does it? Because you've now capitalized on well over a 3-to-1 profit target, which is what we look for on our beginning and ends of the trends. Okay? So then it's always going to be an if-then process, 100% of the time. Okay? Let's remove the drawing tools, just show you how simple this really is. All right, so now we're back into a downtrend. Would you agree that we have violated the previous said swing low? So what's the first thing that we do? Mark the area of supply. So the first time we come back into that area, the first time, okay, we become a seller. Just like that. Without thinking, no holds bars, right? You just do what you know that you should do. All right, all along the way down. So, as we continue, we are looking for the exact same thing, guys. Let's draw the chart up here a little bit. Remove the drawing objects. Okay, we're then going to do the exact same thing. We're going to say, okay, well, what do I do now? Well, I want to look for the end of that trend, don't I? So, let's apply it all the way down, just like that. Then what do? Look for areas of demand. Okay? Do you see how when we violate the trend with conviction, 8 times out of 10, 80% of the time, we will revert right back to it. It's like a magnet. It's pulling us right back to it. You know why? Because the psychology of the markets. There's a lot of buying that took place down here. And the issue is, once we violate back above that trend line with conviction, all of the traders are upset now. Man, I knew I should have bought down there. I knew I should have bought. Right? That's what they're thinking. Yeah, but they didn't. Okay? Not only those people, you also have the people who their orders didn't get filled. So their orders are still sitting on the exchange. So what happens? We tumble right back down and then off to the races we went. Okay? Just like that. But if we open the chart up, we can now clearly see that we're back into an uptrend. Keeping the charts clean, guys. Okay? So right here, we've defined that we're back into an uptrend, haven't we? Yeah, sure we did. We just talked about it. So, what do we look for? Areas of demand along the way up. Violate the previous said swing high, come right back into our area. Okay? What about the next trade setup? What are we then looking for? How about an area of demand after the previous said swing high is violated? Let's mark that level. There you go again. All right? And on and on and on you go. Previous said swing high got violated right there. So we mark the area of demand. We simply want to come right back to where we're willing to become buyers and or sellers in the market. Okay? Always going to be the same. So let's move forward. How do we know what to do next? We're simply waiting for the violation of the trend with conviction. Remember that. So we're going to plot our trend line. Where did we violate it with conviction? Right here. So we immediately say to ourselves, okay, give me a reason. But we don't get it. Look at how close it coming within ticks, and then we drop. We don't actually get that opportunity. So what do? Absolutely nothing. We sit the markets out. All right? And as we continue, we look for areas of supply along the way, guys. Okay? After the violation of the previous said swing low. All right? Just like that, all the way down. Now, I don't want to spend too much time here. I think you're understanding what we're doing with market structure. Okay? When I tell you that it's the most powerful thing in the market, I do mean that. And I mean it because it's pure psychology. It's literally telling us what millions of other people are thinking at the same time. All right? It's telling us what everyone's thinking. By analyzing the market structure and the trend, we know who is controlling the market. By analyzing our price patterns, knowing where the supply and the demand zones are, we know where the buying and selling is going to take place. So if we've analyzed the trend in the market structure and we know that the buyers are in control, we got to then say, okay, well, I know the buyers are in control, but where can I become a buyer? Okay? Then you have to go, remember, you're buying that used car. You have to go look in your account and see how much money you have, how much money that you can put towards that car. We're going to apply the same thing here. We're going to wait for that permission. Then we're going to go look in our accounts and see how much or where we're looking to buy it. And it's always going to be in the areas of supply or demand. So we're utilizing trend following techniques. All right? So I'm well aware that I'm sure you guys see that we have an order that's been going for quite a while here. So let's talk about that really quick. I know that you're probably wondering about that. Why do we have this order here? Why did we get long the markets today? All right? Very simple reason. Very simple reason. We've had 2 long opportunities in this market to get long. One came in here. Must be nice, you're thinking. Yeah, there's no way. I mean, I know, trust me, guys. I've been around the industry long enough to know, skepticism. And I love it. I implore it. I think it's a good thing. Why? Because literally it means that you are at least thinking about it. Okay? You want to go out and do not trust me. That's what it's a bold statement, I know. But I don't want you to trust me. If you just come into the class and you say, okay, I trust you, let me do whatever you tell me to do, then what have you done? You've become a lazy trader. And I don't mean that in a derogatory way. I mean literally. You've become a lazy trader. Okay? We do not need to do that. We need to approach the markets the same way an engineer approaches college. Does he go into college and anticipate that he's going to learn everything in the first quarter of school? No, definitely not. Okay, he knows it's going to take years for him to learn how to do all the structural or whatever type of engineer he is, and then he's not even guaranteed a job. How sad is that, right? We at least are guaranteed a job, but you can't expect to understand everything about the markets in webinars, guys. I'm just being honest with you here, okay? Or in 1 hour, or in a week, or a month even. Okay? It's going to take, 6 months to a year for you to learn to truly read the markets. However, what we have done is literally, we've been, years and years of experience goes into this. We've been working with the best programmers in the industry as well as physicists to get this done. And we have literally created algorithms, proprietary algorithms, of course, to our company, that literally do this for you. Okay? So it's clarifying the areas of supply or demand, because the reason, one of the most reason that we've done this is we've already gotten a statement in the room, as a matter of fact. We've already had a question about it. I mean, it takes about 5 minutes, and someone's already thinking it's confusing, right? And I'm not trying to, I don't mean this in I'm not speaking down to anyone, of course. It is, and I agree with you. So that's the reason that we have actually automated it. Zero subjectivity. So you have a choice. You can either spend years learning this, or you can trade it the automated way, right? So let's turn it on. And let's go back, okay? And let's just find out why we got long 2 times. An area of demand, an area of demand. Long the market's here, here. Actually lost money right here, okay? We actually lost money on this trade and then turned around and played our trap back to the downside for enormous profits, okay? So that was another one. This producing. Notice how we turn out of each. This was a loss here as well, okay? Profits out of every one of these zones that I'm marking, okay? Just like that. We can even go back. You'll see the same thing. Oh, excuse me, guys. Okay, so if I told you that there's a method that is correct, statistically speaking, 70 to 80% of the time, why would you ever argue that fact, right? It wouldn't make sense to. So that's what we've done, okay? So now we're going to, in our courses, obviously, we literally are teaching our traders how to read the markets. So you can apply it to every aspect of your life. You can also apply it to every market out there, all right? Then we are allowing the strategy. They're also trading the actual strategy. Okay, so the strategy is the automation. It's the supply the demand zones being plotted for you. So you can go back to the beginning of time and see the consistency factor. The beautiful thing is we can backtest that as far as we want. Okay, so let's just go back a little bit. All right, and you got, well, we can't go back too far, but you guys can see how the PFA zoning is actually presenting this for you. As I told you before, that was our shorting opportunity here. We took profits here, 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 even out of this sell zone here. All right, all of these back here as well, even on that zone, all of these. Okay, so you can see how powerful supply and demand is in the market. And when you are trend following, notice what you have the capabilities of doing. Okay, but as I stated, the proprietary algorithms know things that we don't. All right, it knows when to counter trend trade the market. Okay, it knows when to trend follow, just like that. All right. Okay, so the trade at hand today, I told you I would bring this up and I would show this to you. All right, so how we knew to get long the markets today. A, because our PFA zoning said so, and that's all that we care about. All right, if our PFA zoning says so, we listen. But if we're analyzing the structure in the market, we're going to pull from the previous 2 swings. So we're going to go from pivot 1, pivot 2, down. Okay, just like that. And we're going to ask ourselves, when do we get a violation with conviction? Right here. So what's the first thing that we look for? Our area of demand. We become a buyer as soon as we revisit that level. Okay? Just like that. So the next thing that we're looking for are reasons to get long the market, even on the way up. So let's open the chart up. So we got to ask ourselves, where do we see violations of the previous said swing high? Right there, yeah? Okay. So then we mark our area of demand. But unfortunately, we never got back. Now, this is a level that I had pointed out in our course, obviously. We do this every day. So we pointed this level out as an opportunity to become a buyer if we came back to it. Remember, we're talking about if-then process. If we do come into our level, then we become a buyer. Okay? For example, if we violate the previous said swing high, then we become a buyer out of demand. If we violate the previous said swing low, then we become a seller out of supply. All right. So if then methodical process. All right. So then we ask ourselves, well, that's unfortunate, but it is what it is. We missed that trade. Okay. On to the next we go. So what happens? We come up, we form a pivot high, we violate, and then what? What do we do right here? Did we not revisit our area of demand? Absolutely we did. Thus our trade long, okay? Thus our trade long. So you can see here, let me get to current. Oh, I'm sorry, I don't even have it on the charts. Well, here, I'll turn it on very quickly, guys, and I'll just kind of display our trade for you quickly here. All right. So as you can see, we had our long entry down here. Okay. As we enter into the market, there's no need to trade 50 times a day. There's no need to trade 5 times a day and or 3 times a day. You can literally trade 1 time a day. Enjoy. Go literally today. I'll tell you what we did, guys. We came in. We placed the trade. Excellent. So on and so forth. We took, targets along the way, which was during our class, and then, we get done with that and we go for a jog. We leave, literally just leave our offices, go for a jog, do whatever it is that we want to do, and our trade's still going. Okay, it's still going. So then we come back and we just manage our trade. That's all that we have to do. That's the beautiful thing about supply and demand, because you predetermine and or predefine your trade setup well in advance. Okay, well in advance. All right, so anyways, the trade took place down at the lows here. Okay, as you can see, we had limit. You see how we got long? We didn't get long on the way up, by the way. Let me point something out here. You can see this by where our order was actually placed. Okay, there's supposed to be a blue arrow somewhere. Let's see if okay, there you go. My candle was too large for you to see it. Okay, does everyone see the little bitty blue arrow right there? Can everyone see that blue arrow? I hope so. Okay, so you can see where our order actually got placed. You see it's right in line, you see, and so on and so forth. So let's open this back up. That's interesting. I've never known that it disappears if you widen your candles. That's pretty interesting. But what I wanted to point out was that we didn't wait for market to turn for us to enter into that position. We were the first buyers in the position, right? Thus, we never have an issue getting filled. So we became a buyer on the way down. Well, wait a minute. That goes completely against the conventional thought process, doesn't it? Yeah, absolutely it does. You know why? Because 90% of traders fail. Why do I want to do the same thing that 90% of traders failing are doing? Doesn't make sense. What about the opposite? Well, I don't want to just do that randomly. I want to have a methodical approach to make money. That's what I want to do. I'm all about making money. Okay? So we know where the buying and the selling is going to take place. Not 100% of the time, but a very high percentage of the time. Okay? As our PFA members would say. So as we come down, if we already know that there's an area of demand where most likely the buyers are going to step back in, how did we know that, traders? Remember, we knew it because on the larger time frame, remember what we just talked about? We violated pivot swing high. We revisited our area of demand. Okay, that's how we knew it. That's how we knew that the buying was going to take place before it ever took place. So we actually got filled here about 8:45, 8:50, something like that. Okay, but our order was actually placed around the 7:45 mark. Okay, so we literally let our trade just sit there for about an hour before it ever actually got filled. So finally it comes down to where we're willing to be a buyer. We said to ourselves, I'm willing to give you this, and that's it. If you don't like it, too bad. Then I just won't buy it. So what did it do? It came down to where the professionals are sitting. Why? Because the professionals are doing the exact same thing. They're not going to chase a trade. You either come to me or I don't want you. And that's what they're doing. So that's exactly what we do. We waited for it. Okay? And then we became a buyer. Now, of course, it went against us a little bit. We took some heat on the trade, as we do most of our trades. Okay, not sometimes we get it to go directly in our favor, but not very often. We'll usually take a little bit, anywhere from a tick, to who knows, a point or two, something like that. And and then it depends on our risk management, of course. We'll tell you about that in the class. But then it turns and goes in our favor, and we do what? Nothing. You know why? Because our targets are already predefined. Just like our entry price as well as our stop was already predefined. Okay? Predefined. So, meaning that we're not going to change it. All right, so then we come up and we take a target right at these pivot swing highs here, because that's a very important structure high for the day. And we really wanted to get above that, so we removed a target from there. And then, as we mentioned in the class this morning, we wanted to allow this to potentially turn into a swing trade. Because if you can make more money, why not, right? So what we do is we have the ability, now this is something I'm going to tell you about our PFA zoning. We have the ability to look at hourly areas of supply or demand on a 5-minute chart, 15-minute, 3-minute, tick chart, doesn't matter. We're using multi-time frame capabilities to do that. So there you have it. All right, just like that. Now you can see we're only looking at hourly areas of supply. So for example, supply and demand. So for example, if I bring this up, I'm just going to come down and we're going to select our PFA zoning MTF. We're going to come up here. Notice we have 60-minute zones on the chart. We're going to apply a 5-minute. Okay? Interesting. We have a lot more zones now, right? Look at that. But don't you find it ironic how the zones work? Guys, it doesn't matter what time frame you trade. It's just the way that it works. Okay? Notice where we stopped, literally on our zone. Okay? Hopefully you understand that. All right. So the idea is that I'm just simply showing you, matter of fact, I can just double click and we'll bring it up. I'm just simply showing you that we're looking at not 5-minute supply or demand. We're looking at 60-minute supply and demand. Okay? So now when I turn them on, notice you don't see that anymore, right? All right. What this gives us the ability to do is intraday trading, but looking at major areas of imbalance, supply or demand on a price chart. So let me explain to you what we did today for his risk management. And you can visit our YouTube channel if you want to see a video of it. But basically what we did was came in after we had hit our profit target, of course. All right. We then say to ourselves, okay, well, if I want to let this turn into a swing trade, all right, but yet I don't want to lose all the profits. So for example, let's say that price would have dropped back down today. Had we not taken some profit, perhaps it would have, and then we would have, only taken off that. So what we said to ourselves is, all right, I'm going to look at the smaller time frame, and then we are going to use our visual occurrence, okay, meaning what we call these are our PFA expansion dots. We're going to use our expansion dots to trail the market. So this is what we do. As our expansion dots move up, thus does our stop. So we move and move and move and move, and then right here. That's where we finally get taken out. However, we didn't move our entire position there. We only wanted to let price run as far as it wanted to go for our next target. As you can see, we still have 2 contracts remaining. All right? So at this point, we're just going to allow it to run because we're now into a swing trade. So what do we do now? How do we do that on a swing trade? Well, we need to look to the larger time frame, right? Let's get rid of all of these. That's kind of annoying having all that. Let me just go ahead and remove this. That's not what I wanted. Sorry, guys. I'm sure you all get annoyed with this on your charts as well. Okay, so at this point, do you see how our expansion dots are all the way down here? So we really have nowhere to go thus far. We need to wait for them to start to climb, and then we will climb with it. Okay, so until then, we're going to let our stop reside at break-even plus commissions. which will protect us in the event that we do happen to drop. Okay, so there's your money in the bank. I've already taken off 2 targets, and the last remaining target is literally just going to run until I get taken out. Notice that we don't have a final target. Excuse me. Okay, so we remove that from our chart. The reason is because if we have a swing trade setup, I can literally trail the structure in the market along the way up, and that gives you the ability to potentially capture the entirety of the trend. Because as we talked about, remember, once the trend is violated, you don't want to be in that trend anyways, right? Because it's going to turn in the opposing direction, just like that. So when the market structure, let's open this, okay, well, bear with me, guys. All right, when the market structure comes up, let's say that it does something like this. Okay, and then we continue higher. All right, and then we do this. What did we just do? Do you see our trend line right here? So what did we just do? We violated the trend with conviction. Okay, so that is now telling us that we no longer want to be a buyer. We then want to exit that position and become a seller because it's already shown true weakness step into the market. Okay, so we get out of our position, trailing structure, and then we reverse our thought process. Notice how that creates a head and shoulders pattern. We covered this in our class today, and I'm not going to give I'm not going to give too much time on this, as it is time for me to now do a quick Q&A. All right, let's roll, guys. Let's do with the questions here. I hope that you found this beneficial, and let me go back and address some questions. Go ahead and feel free to type those in. Let's see. That's only one time, Joel. Yeah, you can only take that one time. Yeah. All right, let's see. What is that? So Diane is asking, what is the red dotted line on the ES? This is our, I think I explained it, but this is our expansion dots, and we use those for visual occurrences to trail our stops. That's what those are used for. Chris, what is my definition of a pivot high or a pivot low? It's a pivot. I mean, I'm not quite sure how to determine. Be a little bit more specific. Remember, what my definition is a rally-based drop or a drop-based rally. Okay, so my definition would be a rally in price, a base, and a drop in price. That would define a pivot swing high for me. A drop in price, a base, and a rally, that would define a pivot low for me. Okay? All right. Okay, let's see here. Yeah, Diane, I think I answered that question for you about how we're calculating those areas. Okay, those are being done for you. And we teach you how to do it in our class, okay, but it's all done for you. Let's see. GL is asking which line is demand and which line is supply. Okay, so demand, think of it this way. Demand is always going to be below current price. Supply is always going to be above current price. So this is supply and this is demand. Okay, so the green zones are buy zones and or demand, and the red zones are sell zones and or supply. Okay. Ken says yes, simple yet smart. Absolutely, Ken. I couldn't agree with you more. Absolutely. Pete, the reason I was drawing 2 white lines is just to, it's the same reason the zone, it's just to create a zone. Okay, so if we open this up, do you see how this zone is here? So I basically had to go in and create, I just did lines instead. I just created a line that way. What that does is gives you the defined area to become a buyer and or a seller. So you're defining the exact area where you want to place your trade. Absolutely. So it defines everything for you. Let's see. Yep, same on a 5-minute chart. Absolutely. We can drop down really quick. I know I'm running on time here, so where's a 5-minute chart? Drop this down to a 5-minute. And yeah, you'll see that it's absolutely the same. Okay? Absolutely the same. Go back and analyze your trend. Just like this. You see previous said swing high got violated. You see an area of demand. There you go. Okay? Just like that. Always the same, guys. Doesn't matter if you're trading a 1-minute or a weekly. It's all the same. Great question, by the way. How did I decide on my stop for that trade? Well, it was determined for me. Okay, if you recall, my stop was determined via the expansion dots. That's how I took my second profit target. Absolutely. Thank you so much, David. He says, awesome, great webinar. I really appreciate that, David. That means a lot. I certainly do. Okay. Jim, I'm not even going to answer that question. That's ridiculous. Is the pivot made up of 3 or 5 bars? Okay. The pivot in itself, absolutely, it's made up more than that. Okay. Let me give you an example here. Okay. You got to have more than that because you have to have a candle that's a basing. Okay. And then you have to have a drop down into it. So it doesn't matter how many candles it takes to do it. For example, look right here. Right here it takes 2 candles to drop, okay? And then it takes you 1, 2, 3, 4 candles to violate that previous said swing high. So you can't define it that way. You just have to know by your market structure. That's why I'm trying to teach you this way. Okay, so for example, if you go back to this, you're going to see 1 bar, 2 bars, 3 bars on the way down, 1 bar, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 bars it took to violate that one. Okay, so it's very different. You can't define it that way. It's defined by a drop in price, a base, and a rally, or a rally, a base, and a drop. Okay. Let's see. Let's see here. Yeah, that's correct, Ken, by the last 2 pivots. Absolutely. All right, and by the way, this is automated as well. We do have that automated, the trend in itself. This is something that we just put on there, and we did this for a client or for a member in the room. But yeah, you're absolutely correct there. Okay. Joel, the idea is, let me help you understand, because basically what he's saying is, I don't understand. Do you use price action and the structure in the market to assess the demand or supply, or do you use your software, the PFA zoning? Okay. The answer is both. Okay. If you want to literally learn to trade the structure in the market, we're going to teach you how every single day. Okay. But the software does it for you. Okay. So let's say, for example, if you want to make money, or you want to immediately start trading, or whatever the case may be, the software gives you the ability to immediately start trading. All you need is the trading plan that we've given, and you're off to the races. But I'm warning you, do not expect to learn how to read the structure in the market in little time. It's just not going to happen, guys. Okay? Not going to happen. You're welcome, Henry. Yeah, thank you. Absolutely. All right. All right, guys. I think that's about all the questions I'm going to take at this point, as I have answered most all of them. One last question I see out here, and I'll go ahead and address this one quickly. And you're very welcome, Joel. Absolutely. Thank you for the very, very good question. Liz, you're asking the chart colors that I have are difficult to discern. Are there color options? Absolutely. So if we wanted to take the PFA zoning, let's say, for example, let's open this back up on the larger time frame. You can do this on any chart. Let's say that we wanted this to be a different color. So let's open this up, all right? And we're going to change the color of that zone. Let's go blue. How about that? Okay. Now you have a blue zone. It's entirely customizable. We can alter, I mean, it's literally, you can customize it any way that you possibly want it to be, customizable to your personality. Absolutely, guys. All right, guys. You're very welcome, everyone. GL, Ken, thank you all so much. Joel, everyone, thank you for being here. Thank you for your valuable time. Listen, guys, from the bottom of my heart, from humble, from being extremely humble in the markets and so on, I just want to tell you that you definitely don't want to look at trading as something that you can do quickly. All right, you want to look at it as a college career. Look at it as something that you're going to spend a lot of time doing, and truly do it right. Okay, and then force your way into a career, and that's the right and proper way to do it. Okay, God bless you all. Thanks so much, Josh. I'm going to turn it back over to you. It's all yours.
All right, thanks a lot, Will. We really obviously appreciate you coming in to present here today. A lot of good information coming through, and it seemed like there were quite a few good questions there towards the end. So obviously we wanted to start off by thanking you for presenting. We also wanted to thank all of the attendees here for joining us for this session today. Obviously we hope you found some of the information helpful and beneficial that Will was presenting for you. We did record today's session, and an email will be going out with a link to that recording tomorrow morning, so be sure to check that on out if there's something that you'd like to review a second time. And then once again, I'd also like to point out the free 7-day trial with Will. The link is over on the left-hand side of the screen, so be sure to fill that on out and sign up and learn more from Will, because obviously there's a lot of good information today, and I'm sure he has lots more to teach you guys. But that should do it for us here today. Hopefully we will see all you guys back here in the coming days and weeks for another future Trader Kingdom webinar event. But until that time, we're going to sign off for now, and I hope you guys have a great rest of the evening, and hopefully we'll see you back here again real soon. Take care, guys.